When we look at our money, we can look at our money or classify our money according to liquidity. When we talk about liquidity, we're talking about how quickly we can turn it into cash. So how quickly can we turn it into something that we can spend? So we have different levels of money in terms of its liquidity. We have what is called M1, M2, and M3. M1 is the most liquid form of money. So it's already in a form that we can very quickly spend. So the most liquid form of money is going to, of course, be cash. So our coins, our banknotes, this is our currency that is in circulation, and it is readily available to spend, to buy things. So it's the most liquid. Now, also included in M1, our most liquid form of money, is what are called demand deposits. And demand deposits are an economic term for the money that's in your checking account. So because you can write a check and have that money withdrawn from there, or you can go and use your debit card and spend with your debit card at the grocery store, it's essentially immediately pulled from your checking account. And so it is a very liquid form of money. If we look at M1, the most liquid form of money, in 2017, that M1 was about $945 billion is the total value of our currency, so our coins and banknotes, as well as the money in our checking accounts, our demand deposits. So $945 billion is how much M1 we have in Canada. You can break this down further, and you find that demand deposits are about 92% of M1, and 8% is our currency. So if we take 945 billion and we multiply it times 8%, you realize that we have about $75.6 billion worth of cash, coins, banknotes in circulation in Canada. Most of our money is not in coins and banknotes. It's in electronic form, right? It's a line on your bank statement that says you have money in your checking account. So actually very little of our actual money in Canada is in coins and notes. So M2 is a less liquid form of money. And when we define M2, everything that's in M1 is included in M2. So what was in M1? That was our currency, and that was our demand deposits. What's also in M2 are what are called notice deposits. Notice deposits is the money that's in your savings account. Now think about when you want to pull out cash from your savings account, right? There's typically a day or two delay to pull money from your savings account. Why? Because that savings account accumulates interest. And so because there's a little bit of a delay in terms of accessing that money, it is less liquid. So M2 is a less liquid form of money. The least liquid form of money, so M3 is the least liquid. Okay. And when we look at M3, M3 includes everything that's in M2. Okay, so what was in M2? Well, we had everything that was in M1, so that was currency and demand deposits. That's money in our checking account. That was the M1. And then remember in M2, we also had notice deposits. That's the money in your savings account. So everything that's in M1 and M2 is in M3. What we add in M3 is money that you have in certificates of deposit, money you have tied up in savings bonds, and mutual funds. Now, when we talk about these savings bonds, these are only government savings bonds. Okay. Now, you can have other entities issue bonds because bonds are essentially a way to raise money. So it's debt. Bonds are debt. You can have a bond, and essentially that's people are paying you money, and then after a while accumulate interest and you pay them back. In fact, when we look at bonds that are produced by the government, that's just you owning government debt. So because it's government, the government is the one responsible for paying you back, it is still considered to be money, right? Because our central bank, our central authority, is responsible for the money in our economy. So we include savings bonds from the government in our measurement of money because there's essentially a guarantee the government will pay you back because the same one creating the money supply is the one that you are buying the bonds from. But bonds are really just you owning government debt. An IOU that the government will pay you back later. But since they accumulate interest and the government will pay you back later, then it's not very liquid, right? It takes a while to get the money out. You have to wait for the bonds to mature. Same things with certificates of deposit, right? They gain value over time because they accumulate interest. And so to get the full value out of them, you have to wait to the maturity date. And if you sell your bonds or CDs, you liquidate them before they hit maturity, then they lose value. So they're a less liquid form of money. We also consider mutual funds, which many of us invest in, to also be a form of money. And of course, it's the least liquid form of money because you can't immediately spend the money you have tied up in mutual funds. If we look at our M3, so the total amount of money in our economy, all forms of liquidity, so those that are most liquid, like cash and coins and demand deposits, as well as our notice deposits, that's our savings, as well as mutual funds and CDs, then the total value of our money in the Canadian economy, in 2017, it was about $2.3 trillion. Okay. When we break that down, you find that about 41% of that is the most liquid form, so currency and demand deposits. About 27% of that is money in checking accounts, and then the remainder is those CDs, savings bonds, and mutual funds. So we can classify our money according to its liquidity. How quickly can we turn it into something that we can spend? And M3, which includes the CDs, the savings bonds, and the mutual funds, is the least liquid. Cash and checking accounts, those are the most liquid because we can spend them right away. What is not money in our economy? Well, we don't accept gold in exchange for goods and services. Okay? Gold is an investment. Okay? It is something you can buy and gains value over time, and then you can sell it later. But it's not money. It's not a medium of exchange. Okay? It's not a unit of account. We don't know how much a Snickers bar and how much a truck is in gold. So it's more like buying a house where it is a way to accumulate wealth, but that's only because you're assuming that when you sell it later, you can sell it for more than you bought it for. Financial securities like stocks and corporate bonds are not money. So while mutual funds and government savings bonds are considered to be money, stocks and corporate bonds are not. And again, it comes down to, okay, how much regulation is there? Who is the one issuing it? And since we have our central authority is the one responsible for our money supply, corporate bonds issued by companies as a way to finance their expenditures, debt, an agreement to pay back later, that is not considered money because you don't have the same entity who is issuing the bonds as you do who is in charge of our money supply. So financial securities like stocks and corporate bonds are not money. We talked before, credit cards, not money. Checks, not money, right? They're IOUs. Yes, they're accepted as a medium of exchange. But the more checks, the more credit cards you have, it doesn't mean that you can buy more stuff in the future, right? It's not a store of wealth. It's also not a unit of account. We don't know how much a Snickers bar and a truck are in the number of credit cards or checks. Debit cards themselves are not money. It's the money that's in your checking account, which we call demand deposits, that is the money. So having, 5 debit cards doesn't make you have more money and able to buy more stuff. It's the money that's in the accounts that is the money.